Thanks for joining us today here at Framework FX, and today we're looking at the Ichimoku cloud strategy, and we're going to go into an in-depth backtest and analysis. Now I know that the indicator on screen looks very daunting, but I promise you it's not. But before we start, I'd like to ask if you would like the video, subscribe and ring that notification bell. We're going to be doing plenty of popular strategies in the coming weeks and you do not want to miss them. Okay, well, let's get started. So the Ichimoku indicator, okay, this is a collection of technical indicators that show support and resistance levels as well as momentum and trend direction. It is primarily a trend following indicator, okay, that's important. I know it looks daunting, I know there's lots of colours and lines, but I'm not going to go into detail on it now. I'll leave a link in the description below on where you can find that information, but it is important that we know these 5 lines. Okay, so we've got the conversion line, we've got the Kinju Sen, or the baseline as it's also known, we have the Senku span A, which is the leading span A, we have the Senku span B, which is the leading span B, and then lastly we have the Chiku span, or also known as the lagging span. Now, as I said, it does look daunting, I understand that, but I promise you it's really not, and we're going to set out exactly how this strategy works. And the 5 lines, when you get them right, they give you a really clear signal on when to enter the trade and where to place your stop loss, which is exactly what we're looking for here, really. So let's go across now and take a look at an example of how the strategy works. So here we have the first setup. The Ichimoku cloud strategy itself requires 4 parameters to be met to give a signal, or 4 rules, if you will. Now, we're using an hour chart here on the pound dollar, so let's take a look at this. Right now, we've got our first indicator. It's often the first thing you see, but rule number 1 is price must close above the cloud. Okay, as I said, it's the first thing you often see, the first thing you look for. It's very visual, and here right now we have done that. So then the second rule, and this is a long trade that we're looking at here, is that the cloud must have turned green, okay, which as you can see we've got is when the Senku spans cross in your favor, and here we have it, we've got a green cloud, perfect. The third one, a little bit more difficult to see, but it's when the conversion line must be above the baseline, okay, and we've got that there. You've got to get in there and take a look for it, but we've got it and it's very important that we do. And then the fourth rule, again, not the easiest to see, but it's when the lagging span crosses above all the other indicators, and again, very important and often the last one that you get to confirm your signal. So once we've got all 4 of them rules met, which we have here, we look at entering the trade and placing a stop loss. Now the stop loss goes below the lowest indicator in line with the candle you're entering on. Here it's the baseline, and then we're going for a 2-to-1 risk reward ratio. Now this is very arbitrary at the minute, and there we go. Not the best example maybe, as we've run straight through the target profit, but you often see this with this strategy. Now let's take a look at another, and here we have no signal at the minute. Okay, we're sat inside the cloud, so let's bring our 4 rules up and let's run through and see what we can get out of this. Running down, still nothing, and there we go. Okay, so rule number 1 has been met. Price is beyond the cloud. Okay, perfect, so we can tick that box. Looking around, none of the others have been met. So if we just run it through a little bit further, and there we go. So just one more candle on and we've got rule number 3, the baseline has been crossed by the conversion line in direction of our trade. Run it a bit further on and there we go. Okay, so we've got the lagging confirmation cross below all of the indicators, and we've got the cloud turning red over on that side. Perfect, okay? So now all 4 parameters have been met and we've got a clear, concise signal telling us to get into the trade. Okay, so now we just have to place the stop above the lowest indicator, which is there. It looks like a big stop, but as we're on the hour chart, it's not really that big, and I found that often you need to give price a chance to breathe a little bit. So this is what it looks at the minute, and if we set that there and we run it, and there we go. And this is quite typical of this strategy. I've found that it does often just run. It gets you in nice and early and just gives a nice strong push down, as we've seen there. Now, there are losers with this strategy. It's just easier to show you winners as examples. But yeah, so now the important bit, let's jump in and have a look at the results. Just before we do that, I'd like to ask you to take a look at our free Telegram group. We post information on trading and we also post free signals in there as well. So join the thousands of people that are already in that group, and also take a look at our website, frameworkfx.com. We do run a full signal service. It might be of interest to you, it might not, but go and check it out anyway. So the results are in, and this is what they look like. Okay, I was pretty impressed with this strategy. I must admit, I didn't go in with high hopes, but as you can see over here on the left hand side, it took 24% across the year, which is pretty good. It had a 40.74% win rate. Not the best, but with the 2-to-1 strategy, it does, as you can see, make us profitable. Now, it is important to discuss the data that we used to get these results. Okay, so it was the pound dollar in 2020 and it was using 2% risk per trade. Okay, now that's important because as we look over here, we can see that February, March, April, May, June, July were really great months for the strategy. Now, again, because it was pound dollar in 2020, we know because of coronavirus that there were big trends in the market. Okay, so I'm not surprised to see that, and I'm also not surprised to see that September, October, November we started to flatten out a little bit and the strategy didn't do so well. Okay, now if you take a look at how many trades were taken, 54 trades taken across the year, averaging at about a trade a week. Now, for me, I think this strategy will go great when you look at adding other pairs into it as well, and start looking at maybe taking 4 or 5 trades a week. I think that it will really improve then, and it's also not very time consuming, which is for some people not great, but for a lot of people really ideal. So I think if that's what you're looking for, this could be a great strategy. If you look over on the right, the win rate of 40.74%, as I said, not bad. It's, you know, we're using 2-to-1 risk reward, so yeah, not bad at all, but not great either. And I think as we look at more data throughout this analysis, we can see ways that we can improve that win rate to make the strategy more profitable, but also more stable, more consistent. Okay, and I do think it's also important to take a look at how many trades were taken per month and how that equaled stronger months and weaker months. So you've got March, 3 trades, 3 wins. Okay, a small amount of trades, and yet it's been our most profitable month. You see the same in May, 2 trades, 2 wins. Perfect, that's exactly what we're looking for. But you go further down and suddenly you've got October, 7 trades. Okay, so it seems like when we're getting more signals, we're also getting more false signals. Okay, so it's really important that we look to sit and wait for them perfect trades. Okay, so as we move out of this, let's take a look at this big segment down here, and as you can see, all 24% of our profit came from long trades. I wouldn't necessarily go and say only take long trades, okay, but maybe something to think about. But the biggest worry here is this max drawdown, minus 30%. Now that's really not what we're looking for, especially if you're looking at combining this with several other pairs, because you're just going to see that max drawdown increase and increase. But I think as we move on here to look at other elements of this strategy, we're going to see places where we can definitely bring that max drawdown down. So let's back out of here and take a look at our times on the right. Now this is really great to look at. It's important to mention that we are based in the UK, so these are Greenwich Mean Time or British Summertime times, which means that the US Open is at 2:30 p.m. Over here in the UK, and this was really interesting. I think this is where we're going to find the most refinement to improve that max drawdown. If you look here, the 3 hours following the US Open was where we took 22 of our 24% profit. Now that's huge. Okay, so straight away you could say, I'm only going to take trades up to 3 hours after the US Open. And already then you're looking at improving the strategy and refining it to a point where you bring that max drawdown down, okay? And also, it doesn't take much time then, okay? You're only looking at a specific 3 hour period after the opening bell. So that's one thing we can be looking at. If we carry on looking, there's not a great deal. It's hit and miss for the rest of the market. But if we also consider that we are based in the UK, so 8 AM is the open in the UK, and if we look here, the first hour of trading in the UK wasn't great. Okay, so maybe that's something else you look at. You look at saying, we don't trade the first hour of the or we don't open new trades the first hour of the UK Open, but the 2 hours following it weren't bad. So again, there are small changes you can make that will improve the profitability and also reduce that max drawdown. Okay, now if we look at the days, again, really fascinating, really great to see. Monday was the workhorse here. It really picked up a lot of the slack, and I would assume that's because a lot of decisions, a lot of announcements made over the weekend. We open up Monday morning, people are decisive about where they want the market to go, and as I mentioned before, this was great at jumping onto trends early. Okay, and if you look down at the bottom, Friday not so well, and probably the converse of the Monday scenario, people not wanting to put their money in just before the weekend, and so we didn't get into any trends and we ended up getting stopped out with false signals. So again, straight away you've got another refinement that you can make there. You can say we don't trade Fridays, okay? And again, you're bringing down the drawdown, improving profitability. So they're just two small changes you could look at, the time and the day straight away off the bat, and that would improve your profitability. So if now we move across and take a better look at the visuals, and they're telling us the same story really. February, March, April, May, June, July, all really strong months, and then September, October, November dropped off. Now taking a look at the equity curve, and you can see we went through January into a small realistic drawdown, and then we pushed off, and we peaked around 44% in the middle of the year before obviously that later pullback that we had. Now the refinements that we've already spoken about, I would like to see that flatten that curve. It'll never be a straight line, but I certainly think those small changes will definitely improve that equity curve and see less of a pullback. Now, notes, okay, so these are things that I picked up on. I've already mentioned a couple. The first one is to refine the date and time. Now this, I think, of all the things we've looked at, is the most important. Monday was a really strong day. Look at focusing in on that, and those 3 hours after the US Open, I think will really, really improve this strategy. Now, the second one, and I haven't mentioned this yet, but it was look for a better stop. Okay, so what I found throughout the testing was that often price would either take off from your signal spot or it would drive straight back through your stop. So maybe using an ATR indicator or something along them lines to get a better stop, a smaller, tighter stop, which will then improve your risk-reward ratio and overall improve your profitability with this strategy. Okay, so they're just that's just another small change that I think you could make to improve this. And the last one, and it goes back to that point, is let the trend run. Okay, so again, what I saw frequently with this strategy was that it got us in at a great level, got us in early onto the trend, it would hit our take profit at 2 times the risk, but then the trend would continue 2, 3, 4 times. Okay, so maybe we look for an exit indicator that is going to maximize the profit that we can take out of the run that we're so fortunate to be on because of this indicator. Okay, so again, just small changes to make. Go away, backtest it. I think you can really find a great strategy in here somewhere. Well, thanks for joining us at Framework FX. Like I said, we're going to be doing more of these videos, so if you enjoyed it, make sure you subscribe and like the video. Join our free Telegram group, some great information in there and some great free signals. And also go and check out our website, frameworkfx.com, and look at our full signal service across there as well. Okay, thanks for joining us and happy trading.